Thank you. I'm here with Kruti Lienbauer. Have a couple extra people show up, but it is Fed Day, so that means it's a good time to bring some people together, hear what their thoughts, feedback, insights from today's news, from what happened with the Fed, which is essentially nothing, and kind of read into what the tea leaves are saying about the economy, rates in the future, the job labor market, all that stuff. I frankly have been just like a little bit of a chicken without a head today, so I haven't even been as on top of it as I usually am. But maybe let's go around the room and make an introduction, and we'll kind of go from there. Here, Dr. Kruti, you want to go first, and then.
Sure. Hi, I'm Kruti Lienbauer, and I am a data scientist and economist by profession. I offer consulting services for a variety of small businesses, and my focus is usually helping them embrace policy changes, which is what makes things like Fed Day and labor stats days really interesting and important for me.
Yeah, good. And Dana?
Hi, I'm Dana Fields. I'm a chief correspondent for middle market coverage at Octus, formerly Reorg Research.
I think Dana's frozen. Oh. Or she's very good at...
No, she's not frozen. Dana, you were on a roll. Ariel,
right,
might be on your side.
Keeping it rolling. Where we cover M&A processes, everything from early stage origination to debt financing and more. Really good timing for us. We just put out our mid-year wrap with a lot of insights as well, and looking forward to sharing those with you guys.
Guy Berger. I'm a labor economist. I'm a senior fellow at the Burning Glass Institute and also a workforce economist at Residence Guild. And I'm obviously very interested in the Fed, mostly through the labor market economics prism. So most of what I spent thinking about today, listening to Chair Powell, was what his assessment of the labor market and what he expects to evolve. And I guess Ariel has deserted us. I assume he's going to be returning. But Dana, do you want to go first in terms of your take on today? I'll take the baton if everybody is okay with that until Ariel comes back.
Yeah, I was going to say, I think you're in charge now. We've taken over. Interesting time. Hey there.
Sorry.
No, we already have taken over without you. We're doing fine. No, I'm kidding. I was just mentioning, how we're feeling, mid-year in terms of.
I want to turn my camera off.
In terms of institutional investors, we're feeling good. I'm seeing lots of positive sentiment, especially compared to Q1 and Q2 of this year. If you remember last time we talked, right around announcements around interest rates, a lot of trepidation, a lot of uncertainty, a lot of maybe frustration. I'm just feeling like a lot of that has melted away. It's kind of in the rearview mirror. There was a lot of hyped up demand in Q1. We kind of got out to a rolling start, and all that was kind of tempered by those surprise announcements. And I'm just feeling like that excitement from Q1 has returned. I know on the M&A front, what we're seeing is a lot of that. A lot of those processes that were put on hold from earlier this year have returned to market on top of the usual kind of mid-year activity. So investment bankers, private equity firms, I don't want to use the word slammed, but we're seeing healthy activity, a lot of optimism for the rest of the year, and definitely a lot of refinancings, which I think is very interesting. And we definitely saw a lot of companies looking to refinance some debt earlier this year that never got done just because of that volatility we mentioned. Well, they're finding it a good time to come back, and they're getting that done. There's a lot of hunger out there for some good paper, and we're feeling good about it. And I don't know if that jives with what you guys are seeing kind of more at the consumer level, but I'd be very interested to hear.
Kruti, do you want to take a crack at it?
Sure. I've been one of those people who was very pro increasing interest rates when our inflation was at 7 and 8% in 2022. I didn't expect them to do it so fast at that time, which is what makes this stagnation really hard right now to understand. The inflation is down. Yes, it keeps bumping up and down, and there's other fiscal aspects of it, but monetary policy is not supposed to really work so in hand with fiscal policy anyways. There are two different parts of the economy, as all of us know. And so it bothers me that in an increasingly inflationary or claim that there could be inflation based on tariffs, we are cutting off small businesses by keeping those interest rates so high. And I think it will, so, like when I see the workforce and the numbers not really going up, not going down either, part of it is because we are stagnated. People don't know what to expect. And the Fed constantly taking the stance of, well, we're just going to wait and watch, is not helping. Now, if we were at a 2.5% interest rate and they were just watching, it makes sense. You're at close to 4.5 as the federal rate. That's, to me, that's a little unfair to the small guys in the country. But maybe that's just me. So that's my first take on it.
So I think as far as what my takeaway was, I think it's a very labor market centric perspective.
So I totally hear that. Thank you.
Is that first off, the one thing that Chair Powell said, this was a response to a question from Neil Irwin at Axios. Neil asked about like the weaker GDP numbers. I mean, they were strong today, but just in general, GDP growth has been substantially weaker in the first half of 2025 relative to what it was in 2024, much of 2023, when it was running consistently at above 3%, not just at about 1.2, 1.3%, which is what the average has been in the first half. Also about employment growth being weaker. And Powell said, listen, you can't pay attention to these things, understanding like how monetary policy works. You have to pay attention to the unemployment rate, which has been stable now we'll see what happens tomorrow, but at least through June have been stable for 11 months. And I think with forecasts expect is going to stay in the same range in July. A lot of other indicators in the jobs report and in the JOLTS report have been stable in the same way. It's just essentially what's happening is we have a bunch of policies all hammering the economy at the same time. Some of them pushing the demand side down, some of them pushing the supply side down, which is what we have, slower GDP growth either way and slower employment growth. But they're keeping the level of excess capacity in the labor market, other parts of the economy relatively stable. And they've been kind of a wash. I think it surprised me to some extent. I expected the labor market to get weaker. I think it surprised the Fed a little bit. They expected that unemployment would go up by the end of the year, and maybe that'll happen. I mean, I would lean toward it is likely to happen, but I think they were expecting it to happen sooner. Yeah, I think that basically like the Fed is very much in a wait and see mode right now, which is not making the administration particularly happy. And candidly, until they gain more confidence on inflation, which maybe will happen over the next few months, maybe it won't, unless the labor market takes a turn for the worse, which has not happened, we're going to be waiting a while. Dana, you unmuted?
Yeah, I'm here. Can you hear me?
Yeah, I can hear you. Can you hear me? Am I cutting out too?
No, you're doing good. Yeah, we're going to be waiting a while. You mean for interest rates to ease?
Yeah, I think like, again, I don't know. I know a lot of people expect September. I think for that to happen, you're either going to need inflation data to clearly show signs that the tariff impact is fading, or alternatively for the labor market to get worse. And if it doesn't, I'm not sure that like the Fed's going to ease in September either. Like, again, if the data looks like it does right now. Right.
And I think that the little bit of guidance they gave us is maybe a few bips easement by the end of the year, maybe one or two haircuts by the end of the year. I think from the institutional investors point, also skepticism on whether actually we will realize that. But one piece of optimism that I find interesting that we're hearing is that Jerome Powell's term coming up in May 2026, believe it or not, just around the corner. And it does, I think on the investor level, it's providing some degree of guidance, of a little optimism. I think that Trump, as he starts floating names, he doesn't have influence over, who replaces him, but he kind of does. And it could be probably more kind of business friendly names. I think that provides optimism to the business community. And at the end of the day, in an environment with so much uncertainty, so much volatility, it's something to grasp onto, that we could see some kind of endpoint to these high rates, that really a lot of expectation that at the very end of the road could be roughly around May 2026. That's something to kind of forecast against in terms of business planning, and I think it's providing some assurity. And I also think that kind of seeing that, I'm seeing a lot of big mergers being announced, unpublished stories. We're seeing a lot of green shoots in companies and private equity firms coming to market with those assets that they held on for a very long time to. That's very positive. And it does speak to their optimism that valuations are kind of getting reassessed. That's positive as well. And, there could be that trickle down kind of optimism. I mean, that's something. Not much, something.
Kruti?
I agree, and I want to remain positive. I'm an optimistic person in general. So I know that we'll all get through this. Ariel and I were talking earlier about the good thing about today was that nothing bad happened, right? Like basically in terms of the Fed situation, we are where we have been for 7+ months. But the way I'm thinking about it is a little, I work with a lot of clients that are banks, different size banks. And one of the big things that most banks can make money on is loans and the applications that they get for loans from individuals and households and small businesses, right? Because these are not all JP Morgan or whatever, right? Chase. And there is a sharp and distinct correlation and causational relationship between the federal interest rates and the number of loan applications. It sounds logical, but I'm still saying it to clarify what my concern is. A lot of these banks in the last 2.5 to 3 years, because of other external factors, have seen a sharp decline in the number of applications that they get. This makes it hard for them to start predicting how many loans they need to make, how many new products they need to launch in order to compensate for their losses, because they might be willing to give a higher proportion of loans, but there are just not as many applicants as there used to be. And this drop is so significant that unless and until they're able to start climbing those numbers up in some way, shape, or form, a lot of these banks will end up shutting down, and it wouldn't be regulation related. And that, considering my bread and butter comes from a lot of these banks, is a huge concern for me personally, but also because of this reason. So I keep hoping that something will change. I keep hoping that suddenly people are just going to go apply for more loans, but not with this uncertainty. Either they need to start saying things like, we're not changing the rate for another year, deal with it, or they need to change the rate. This play on both sides of this political theater. Oh, let's do this. Oh, no, let's not do this. Oh, let's do this. Oh, no, it's not helping anybody. And it's actually whipping up the frenzy and the panic and the uncertainty even more. So something needs to settle. That's my take on it.
So Dana, were you going to say something?
Well, just on that back and forth, yeah, no, I completely agree. And I think, in Q2 or Q1, I was covering a number of companies that were in the process of refinancing their debt. That when the liberation, actually, right, a very specific company, Finastra, big, $4 billion loan. I think they were trying to refinance some debt, and they paused it because I had a source that felt certain that rates were going to drop around June. That was before Liberation Day. Then Liberation Day came out. Then everything kind of went shaky. Then everything stopped. Okay. Then we get to June. Then they're not going to drop rates. So it was definitely a lot of optimism and hope that we're going to see movement. Then we're seeing no movement at all. So definitely that registers. As far as those lower market bank financing loans to those smaller businesses, part of what I cover is private credit. I'm sure that's eating into the lunch a bit on the traditional banking side. So while rates are high, yeah, banks are suffering. On the other hand, on the other side of that, private lenders are profiting. It's a good time to be in private credit right now. You're going to pay a little bit extra for that loan, but there's some certainty that comes along with those kinds of business loans, and it's a very relationship-driven business, and it is, again, like a lot of certainty in an environment with a lot of volatility. So that's one silver lining.
So I want to poke at something that Dana, that you said, which is, investor optimism about replacing Powell. I think this is very much a double-edged sword. I mean, it depends on who replaces him, and administration gets to choose a new chair, and the person needs to get Senate approval. But I think that the risk with the possibility of putting in somebody there whose main objective is going to be to ease monetary policy very quickly is. That's the kind of thing that historically risks causing inflation problems down the road, and the kind of thing that may result maybe short-term rates going down, but long-term rates going up. I mean, to some degree, I think you could argue that, we've seen since the Fed started easing in 2024, mortgage rates are about where they were, before they started easing. And the reason is that, in the end, the Fed doesn't control long-term rates as much as they control the short-term policy rate. And so, again, I think that there's the risk. It depends on who replaces him, because I think that there's some, the choices that I think are very reliable. I think that, one person that a lot of people in markets really like is Vice Chair Waller, who actually dissented today, wanted to ease by 25 basis points. And I think there's a range of I think we can all agree that there's, debatable should easing, Kruti, I think there's definitely a case, especially if we take the downside risk more seriously, that maybe a little bit easing happens. But I think monetary policy under most of these kind of well-regarded paths would not be dramatically easier under a, alternative. The other possibility is you ease a lot and then you kind of risk overheating the economy and potentially causing another inflation problem. So I do, there's no until inflation really plays ball. The amount of panacea that we're going to get out of monetary policy, I think, is limited, right? You just really are. And I think that's sort of the challenge. Again, I think there's debatable whether the Fed should be easing a little bit now or not, but there's not a lot of easing in the future without a lot of improvement in the inflation picture going forward, in my opinion. And if you do cut a lot without that, then you're potentially risking a big inflation problem down the line.
I don't think anyone's going to come in and start weed whacking rates. We're all expecting 25 bips at a time, right? Kind of a little bit here, and you see how the reaction is, a little bit there. So whoever gets in that's going to be the gameplay. But I think that it's just tough for Jerome Powell to play that game right now because of a lot of talk in the market from the administration, and he's coming up, he's got a legacy to think about. He's coming up to the end of this term. Does he want to be perceived in a certain way where whether it's true or not, kind of appears pandering maybe to the administration? Honestly, if there weren't so much rhetoric going on, I think he'd feel more free to really do. But coming up to the end of this term, I think he's got a lot, to think about image wise. I think that's what's really holding things up, maybe a little bit of it. So I do think that whoever comes in, in May, we'll feel a lot more freedom to enact that play. What do you think, Dr. Crudy?
I agree with you in terms of where Powell's situated right now. But then here's my problem with him. When he makes claims like, we have nothing to do with fiscal policy. He made that claim today after the meeting. And it's like, all right, you literally just told the whole world that tariffs is the reason why you won't budge. You literally just told the whole world that it is the shifting of the IS curve from an ISLM perspective, for those of you who have the economics background for it, that it's the IS curve that's raising all these price levels, and the monetary policy is just making sure it doesn't affect the interest rates. And at the end of the day, the question is that if you actually think about how the ISLM curve affects our aggregate demand and production and inflation or price level changes in the economy, bumping those interest rates up, it's going to shrink the economy. Yes, keeping them high is going to reduce how much output we can produce. And when we, in a rapidly digitalizing world where people are already terrified that their jobs are going to be replaced by automation and AI, we are telling businesses of all sizes that, yeah, you can take private loans, pay a little bit more for it, but you know what? Every time they pay more on those interest rates, they're taking away someone else's salary. And so there is that whole, while interest rates, when they naturally change, they impact unemployment. Standard Phillips curve, classical, I know, not a lot of economists agree with it. I can see guys smiling. But at the end of the day, what is causing that inflation is the key that needs to be considered. What is causing labor changes is the key question. What is causing price changes, and in which sectors? Because if you actually break down inflation data, there are some sectors which are actually significantly dropping in price, but there are some which are overcompensating for it, and therefore we see a high inflation rate. We can't use a one-size-fits-all when so much is at stake for various businesses and people. And that is why I don't care, honestly, who replaces Powell. I just like the fact that there is that question being asked. That because we're already dealing with one person who thinks that they come next to God, and now we have another person who wants to play the same game. And it's just like, what about us, the people, right? Like, I don't want to worship either one. Can we just move on, But I don't like this. So I think, considering I just said I don't like their opinions and being like super opinionated right now, I just thought I should share why I believe what I believe. And I'm glad that Powell's under a little bit of fire, because I think it's time that he steps up and not backtrack himself and contradict himself all the time. It's almost like he's having, have you heard the joke that 3 economists walk into a bar and they had like two economists walk into a bar and they have 3 opinions, and that's because one of them was Keynesian, right? Like, so it's one of those things. It's a silly joke, but I agree with you, Guy. Why don't you take over?
Yeah, I don't like, to me, a lot just really depends on how the inflation data evolves. And I guess what I would love to hear from Powell, and he's going to be vague about it because he always is, because he doesn't want to pre-commit himself, is like, at what point would he gain, what would take him to get enough confidence that the inflation impact of tariffs is transitory. I think what, by the way, he said, which I thought was interesting today, which I think is kind of true, is he's like, listen, if we already, our forecast already kind of expects tariffs to be, the tariff impact on inflation to be transitory, otherwise we'd be raising rates. But I do think like there's a certain point, because again, the Fed still has, I think, a fair amount, if you look at the forecast, a fair amount of, let's call it medium run confidence that inflation after this bump in the road is going to resume its downward drift. That downward drift is essential for more easing, and that's why they have more easing built into their forecast to some extent later this year into next year. And I would really love to know, maybe the market's right, and I think by the time we have September's meeting, I guess it's going to be in mid-September, we're going to have 2 more months of inflation data, and the Fed's going to have enough confidence that, like, we've seen the worst of the pass through to inflation. Maybe not. I mean, like, I guess, I kind of made some comment flippantly on social media a few weeks ago, probably maybe even a week ago, but like, oh, we just have to wait a few more months. So the Fed said, like, has confidence, sees we crested the impact of tariffs. And then somebody come in and said, Guy, why are you assuming that we're going to have clarity on the pass through? Maybe there's something that plays out over a year that, like, it takes a full year for that impact to be seen, in which case the Fed's going to have to make judgment calls well before then, because I think a year's a long, unless the labor market just keeps holding and we're lucky, that's a long time to wait for interest for policy to change. And I guess I don't know. I'm not an inflation expert, by the way, so, like, I'm just kind of raising my hands in the air, but I guess I'm just interested in what is going to take them, what is going to be enough to justify, in Chair Powell and the majority of the committee's eyes, justify easing.
Yeah, so you're saying that they're going to want more than a few months worth of inflation data, a year's worth?
They might. I don't know. It's funny because I don't have. My feeling was, my initial gut was they just need a few, and then somebody else came in and says, "Why are you so sure that we're going to have clarity after like 2 or 3 months?" I don't know. Again, I'm not an inflation expert, so I don't know. I was left scratching my head. Saying, that's a good point.
Well, I will say, there is pressure. They're feeling pressure from the business community. Everyone's real anxious to get deal making back on board. And I'm positive that people are in their ear. There's a lot of optimism out there, a lot of pent up that people want to deploy money. And they want to see some downward movement in the rates. That 25 bips, I think, would go a long way in terms of confidence. And again, I think we're already seeing processes and companies come back to market regardless of the rates, staying there. And that just speaks to, the real eagerness to get everything back on track. I do think that rates will follow, like I said, if not this year, probably by May of next year. I'm not sure. A year sounds like a long time with a lot of pressure that you'll have to withstand before you do something, and that's could be uncomfortable for a lot of people.
All right.
My take on it, I ran a few questions through AI before we got on this call. AI is telling me that inflation is stabilizing across gas, groceries, and utilities. It's a good time to rebalance budgets, invest in your 401k, use tax advantage account. AI is very optimistic about our economy right now. It's feeling bullish. For sure, for what that's worth.
Kruti,
any closing thoughts from you before we wrap up?
No, I think this was a great discussion, and given the three of us and different expertise or skill sets, I should say. I don't like using that word expertise very loosely, but it's like different aspects of the economy, right? So you have like the investment aspect and like the labor aspect, and I do a lot of the banking and inflation. I do keep a close eye on it. It's just kind of what I've done for my whole life. But yeah, my data science ARIMA models are not on the same page as the AI models. That's because I build my own. But that being said, I do think that if they just pick a side and stick with it, we'll be better off than this whole, we'll see in 2 months. We'll see in 2 months. Like that's my takeaway. I think that should be like a meme, right? But anyway.
I completely agree. It almost feels like a touch and go game that they're playing. Just any kind of, for the next 6 months, 12 months, you can expect this. That would be nice. I guess that's just not how they work. Yeah. But I do think that I think our markets are resilient and optimistic, and there's a lot of energy. I'm feeling really good about the rest of the year, and even a 25 bit rate cut would exacerbate that and get us rolling again. We can only cross our fingers.
All right, Ariel, we miss you, and Dana, Kruti, I had a great time chatting to you guys again, and I'm guessing we're going to do this again in 6-7 weeks.
That'd be great, Guy. Thank you.
Sure.
Looking forward. Great panel.
Thank
Bye.
you. Bye.